Today we are looking at Apple Inc. ticker symbol AAPL. It is currently trading at $175.11 a share. News has come out that Apple has lost its smartphone crown to Samsung as Chinese rivals gain ground. iPhone sales fall 10% in the first quarter of 2024. So we're going to be talking a little bit about this and then going to my automated stock valuation spreadsheet to go through the company's financials and see if it is a buy based on discounted free cash flow model, the comparable company model, and finally the Ben Graham formula for intrinsic value. So yes, just touching on the news here, iPhone sales fall 10% in the first quarter of 2024. And yes, as we can see here, if we scroll down, this is the unit shipped, and Samsung has reclaimed smartphone market lead as Apple sales fall. There's Samsung up at 60 million, Apple 50, Xiaomi at 40, Transition, and Oppo. So these are the current standings in terms of smartphone sales. So let's have a look at Apple's share price. As I said, $175 a share. Over the last year, it is up about 6%. Quite interesting to see. It basically had highs of around about 195, touching that $200 share, and down 11% since then. But if we look at the last 5 years, it is up almost 224%. Now, if we were to compare that to the S&P 500 at a similar time, well, there'll be no strangers here. It will beat the market over the last 5 years, up 242% compared to 73. But quite interesting, year to date, Apple is down 6% to the market, up 8. So let's see if this is the right time to buy. So we'll go to my automated stock valuation spreadsheet. Links are in the description below for Patreon. But yeah, this will load up all the company financial data. Price $175 a share. Market cap of $2.7 trillion, making it the second largest company in the world, only behind Microsoft, or second largest company in the US, most likely the world. PE ratio. The average PE ratio currently is 27.78. Apple has a lower PE ratio than the market, so that is a pretty good sign for those who are more value investors. Earning per share, $6.43, a beta of 1.27. 15 billion shares, and a target price from analysts of a 187. They do pay a dividend, 0.54% dividend yield, which is just shy of $1.95. They pay around 14 billion, and this is a very safe dividend of payout ratio of 14.5%, or a free cash flow payout ratio of 13.6. Now, if we go to dividendmax.com and have a look at Apple, if I can spell it right, Apple's ex-dividend date, you can see it is 10th of May. So buy your shares before then if you would like to get paid around about the 16th of May. So yeah, buy before then. So this is the sheet. It's got a little summary here. I am actually adding overviews here where you can get sort of a general view of things, but we'll just go down and look at things individually. So firstly, we are looking at revenue, and this is, well, you can see this is with the trailing 12 months. It has been flat the last few years, 385 billion. A 5-year CAGR of around about 7.4%. So revenue has slowed over the last few years. It's down from its all-time highs of 2022, up basically of the last 4 quarters of this current year compared to what it was in 2023. Now, I did want to have a look quickly at their last earnings, basically discussing on that they are no longer the leaders in smartphones, but in terms of their revenue, the product side is 96 billion here. If we look at the net sales on the product side rather than the services, iPhone is the largest with 70 billion, with Mac, iPad, wearables, and then services actually coming up second place. So iPhone is the backbone of Apple, as I'm sure everyone knows, but I think it is interesting to bring that up. Next, we're looking at net income. This is the profit, and we can see here, yes, 100 billion in the trailing 12 months, all-time highs, but once again, profit is slowing. Let me just move this over here. I've changed it. This is a 10% CAGR from 5 years ago, but as you can see, it is slowing. Shares outstanding, are they buying back their shares? Are they issuing more shares? Well, they have done a couple of splits since then. But if we look at the trend line, obviously the trend line is going down. So they are buying back their shares, rewarding shareholders. Now, if we look at the stock price, over the last 5 years. I mean, the price has been increasing. Maybe they should have been using this to invest in capital otherwise. So maybe buyback's not the best idea for a stock that is gone up around 200% in the last 5 years. Assets versus liabilities. Liabilities is about 290 with assets about 140. So they have been pretty much in line. They did... you can see here kind of the liabilities have increased compared to the assets over the last few years, so potentially a bit of a worry, but overall I'm not too worried. Then we look at free cash flow. Why do we care about this? Well, this is what companies use to pay more dividends if they want to, pay down debt and grow. And you can see they currently have 106 billion, 9.2% over the last 5 years, down from its all-time highs of 2022, but basically the line is trending up generally. Now we'll go have a look at the discounted free cash flow model. This is a way of evaluating companies using estimating future free cash flows, discounting them to today's value. We're going to look at the trailing 12 months because we do have those numbers. So let's see what we have. Currently, it's saying it's a $94 stock compared to the 174. So let's have a deeper look at these numbers and see if we agree with them. So obviously, this is... In terms of revenue, what are analysts saying? Where would they expect the revenue to be? Oh, Yahoo has changed their website. I suppose 362 in the current year, 385 in 2025, maybe on the high side of 400. Oops, sorry, let me redo that. And then we'll have a look at what they're expecting per annum on growth at the bottom. They're expecting around about 10% growth a year. So let's have a look and let's go with about 10%. Which does put them on slightly higher numbers, but let's see. So that brings it to $108 a share. Net income margins, I think the net income margins are pretty solid. We'll in fact increase it here to about 26%. That would put it at 133. And then finally, free cash flow to net income. I mean, we'll use the more recent number. We'll go 95%. $120 stock. So discounted free cash flow, doesn't really like this stock, but normally... I'm surprised at that, to be fair, but normally they don't like these larger tech giants. Now we'll have a look at the comparable companies model. This is a way of valuing companies that are in similar industries, similar values, and looking at metrics. The metrics that we're looking at here, I've added a few extra ones. We've just added this in. This is price to sales, which is the the price to its revenue, it's to its sales. Price to book, which is the ratio between the book price and the stock price, and the book price is the total assets minus intangible assets minus liabilities divided by the number of outstanding shares. Next, PEG ratio, which is Peter Lynch's ratio, price to earnings growth. 1 fairly valued, under 1 undervalued, and over 1 overvalued. EV to revenue, EV to EBITDA, earnings before interest, earnings before pardon me, earnings before interest, taxes, depreciation, amortization, easy for me to say, and then PE ratio, which is price to earnings. So let's have a look at some of their competitors. I'm going to say Microsoft are a big competitor. I think Meta in the phone space, or in terms of where they're going with the sort of handhelds, is an interesting one. And then also we will look at Google. These are all very similar size prices. Similar size in terms of equity value. Microsoft being the biggest, then Apple, and then Alphabet, and then Meta. Revenue. Apple is actually the highest revenue, 383 billion compared to Google, but it does have the slowest 5-year growth rate, 7% compared to 14, 19, and 17%. EBITDA, 130 billion, highest again. Net income, it's the most profitable company as well with $100 billion. Profit margin, third highest, 26% compared to 36 for Microsoft, 30 for Meta, and 24 for Google. Then price to sales, about in the middle here. It's actually lower than the averages, 7 compared to 13, 9, and 6. Price to book, highest, 36. PEG, it's looking at this according to PEG. I mean, Peter Lynch would probably like Meta the most, but it is very in line with Microsoft, so nothing to too worry about here. EV to revenue, looking good. EV to EBITDA and P, one of the lower P. So this gives a calculated stock price based on these metrics, $220 to $177, which gives an average of $201 a share. So compared to these companies, it does look slightly undervalued. Next, we'll look at the Ben Graham formula for intrinsic value. This is a way of valuing stocks, looking at earnings per share, growth rates of non-growth companies, corporate bond, and the AAA bond yield. Currently, bond yield is around about 5%, and analysts are expecting, as we saw before, them to grow at around about 10%, and I don't think this will be a buy, according to Ben Graham. Yes, $100 stock. Currently, but if we do look at that again and see the the growth that they were doing around about 22%, would they be a buy? Still no. Interesting enough, it's about fairly valued if they continue to grow at the other rate. So discounted free cash flow model doesn't like it. Ben Graham model doesn't like it, but comparable companies model, looking at Microsoft, Meta, and Google, it does look as if it's a buy, and I think this is a very good metric to compare it against these companies. Right, guys, thanks for watching. Check out my Patreon if you're interested in this, and yeah, subscribe, like, and all that fun stuff. I'll catch you guys later.